Hello and welcome to Options in Plain English. Today we're going to be talking about analyzing the risk profile graph of a long call. A risk profile graph is a graph where you can see what a certain strategy would make in terms of profit and loss at different points or different prices of the underlying. So basically what it is it's a graph. It's a two-dimensional graph where you have two axes, and on the x-axis we have profit and loss, P&L, positive or negative, and on the y-axis you have the underlying price. So it's important to notice here that it's the underlying price that's displayed on the y-axis. So this is not time passing by, this is the underlying price. So at a glance, we can see what would happen and what our strategy would be making if the underlying price is at a certain point. So for example, if we start looking at this one without knowing anything and without even before we even start to analyze it, we can see that this is the solid. Let's focus on the solid line. If we focus on the solid line, you can see that there is this line that shows you that in this case, if the price of the underlying ends up at expiration being here at this point, then the P&L for that strategy would be over here. So it's a very easy way and a very at a glance way to see what a strategy does and how we can use it. So if we start analyzing this, and we're going to start by looking at the different elements of the risk profile graph, and then we're going to focus on this particular strategy, because you're going to be needing this information for future strategies as well. So like I was saying, we have the P&L here. This line, the y-axis, shows you the 0 point. So at this point there is no profit and no loss. And underneath, if you go anything below this is a loss, and then anything above this it's a profit. Now we have a solid line here, which is showing the price, the P&L at expiration. So this is the P&L that we would have if the price of the underlying at expiration is at this level. This axis representing different prices. So this line represents the P&L at expiration. The dashed line represents the P&L at a time prior to expiration, because this graph, this line, is not the same at all times. It changes with time because there is less time remaining, so the price of the different options is going to be changing. So for example, in the case of a long call, we would have a certain number of elements here. We would have this price, let's say the underlying is at a certain price. This is called the at the money price, which means the current price. If we have the at the money price right here, and we have this circle with a C in the middle representing a call, and because it is on top of the axis, so it's above it, not below, but above, it means that the trader bought the contract and didn't sell it, but bought it. So for this call that was bought at the strike price of K here, so K representing a strike price, C is represents the call and also the price, the premium that was paid for it. If we have a certain price of the underlying at the money, and we buy a call for price equal to C, just to represent it, at strike price of K, if at expiration if at expiration the underlying price is anywhere below K, so anything from here to the left, then there is going to be a max loss, which is equal to what was paid for the debit that was paid for when the premium was bought. If it hits the strike price and it starts going above the strike price, then you start making money because the option is going to have some intrinsic value. But first, you have to take into account that you paid for this option. So you have to go to a certain point beyond the strike price before you can break even. The break even point is going to be where the distance from the strike price equal from the strike price to the underlying price equal the value of the call. So basically you need to make this money before you break even, and anything beyond that is going to be pure profit for you. So if we look at this graph, we can see that it's basically representing buying a call. And when you buy a call, you have to have at expiration the price go beyond the strike price so that it has some value, and then it has to travel at least as far as the distance that's necessary to cover the original premium that was paid, and then anything above that is going to be profit. The dashed line is going to be representing anything that is not at expiration but prior to it. So this line is going to be changing day by day, basically starting over here and approaching ever so slowly day by day the solid line until at expiration it becomes the solid line. For a long call, the structure, meaning how we build it, is we are long one out of the money call. Later on, we're going to see what out of the money means. It basically means for calls any price that's above the current price, which is called at the money. So you buy one out of the money call at a strike price of K right here. And that's the structure. That's how you build it. Just buying a call. The max profit is going to be unlimited. It can go up to any price you want. It could go to, if you start with a stock at 100, it can go to 200, 300, 400. It has no limit, at least in theory. The red area, something I didn't mention before, is that the area where you're going to have losses. So basically, the red area means that you lost money, and the green area means that you made money. So it changes right at the break-even point. The break-even point is defined as the strike price. So the underlying price has to end up at the strike price plus the amount paid in premium when the call was bought, and that would be the break-even point. Anything beyond that, anything above that is going to be profit. Anything below that is going to be loss. The max loss is going to be the cost of the call. So basically C. And here I'm showing you just that the solid line is the expiration line, and the dashed line is called T+1, meaning from the time we started, sometime after, but not yet at expiration. So this graph is going to be a way to show a way to display any strategy. This is one of the simplest one. I would say the simplest one, but later on we're going to start combining them, and you're going to see that having these types of graphs and interpreting them and looking at them and being able to figure out what all these symbols mean is going to be very important for you, because now you're going to know where the break-even points are, how to make money. Do I make money when price goes up? Because this is the underlying price at expiration and at a certain point before expiration. So prices that go higher are going to the right, and prices that go lower are going to the left. Similar to how a price chart shows you prices that go higher going up and prices that go lower going down. This is left and right. Left for lower prices and right for higher prices. So this is basically how to analyze this. This is the same thing that we saw in the example, in the explanation that we had in the first video. And we can see that it's a very easy and a very graphical, a very visual way to analyze a strategy. Buying a call, you buy the call. You need your price to go at least above the strike price by the difference between by the amount that you paid for the call, so that you can at least offset what you paid for it, and anything else is going to be profit from this point on. And of course, prior to it, you're going to have a different curve. It's going to be a curve where you can see what the price would be if the underlying price moves in here. For example, prior to expiration, the break-even point could be before that, because there's still some time to go, and the option is going to get a certain value. So this is basically how to analyze the strategy of being long a call, so buying a call. And now we're going to do an example. So for this example, we're going to have certain underlying trading for $90. So we buy a call at the strike price of 100, and we pay $4 for it. So with this information, we can easily see that the break-even point would be when the price of the underlying ends up being at least $104. So basically, the 100 that's the strike price plus the price that we paid, so that the call in this case starts gaining value here, and right here it's at break even. Anything else is going to be pure profit. Of course, prior to this, see, most places that teach how options work focus exclusively on price at expiration. I want you to start getting used to looking at not only the expiration solid line, but also the curves that make up the T+1. So basically any time that's prior to expiration. So we're going to do now another example. What will happen if at expiration our underlying price goes to $170? So you bought the $100 strike price call for $4 when the price was at $90. Now at expiration, the price went to $170. So it went $80 higher. What's going to happen to your call? What's going to happen to your strategy? Are you going to make money? Well, your price is going to be basically here. So that's what this line is showing you. If you go to the solid line, if you go to the dashed line, so if it gets to 170 before expiration, then it's probably going to be higher because the dashed line is a little bit higher than the solid line. So what's going to happen at expiration? If the underlying, represented by the lowercase letter U, is trading at 170, my profit and loss is going to be the 170 minus the strike price, which is 100. So this is the amount that the call is above the strike. So the amount that the call has value for, minus what I paid for it, which is $4. So my profit and loss would be $66. Now, notice something here. The price of the underlying went a lot higher, $80, so almost doubled. But we put down here $4 for the call, and we had a profit of 66. So it's basically, we had over a 1600% return, 1,600%. This is the money that we made. So whereas if you had bought the The stock, you would have almost doubled it. With options, you're able to get it 16 times. So it's basically 16 times over what you put in. So this is the one of the reasons why we use calls, why we use puts for leverage purposes, and to be able to gain exposure to the market while only putting in $4. Remember, we're not going to be exercising. We're not going to be doing anything like that. We're going to be buying the call in the market, and then we're going to be selling the call on the market as well. So we're not going to be needing to exercise or anything like that. We just buy it, we sell it. And now we're going to be taking a look at some examples in the platform so that you can see how it works in real life. And now we're here on the trading platform. We're going to be actually simulating buying a call so that you can see the risk profile on the actual platform, and you can try to map it to a real life example. So in this case, I've pre-selected IBM, but you can select any stock, any ETF, any future contract, doesn't matter. Options are the same regardless of the underlying or what type of underlying we're using. So in this case, we have IBM. It doesn't matter what they do, but we all know what IBM does, and it's basically a consulting firm now. Used to be involved in the manufacturing of hardware, but not anymore. So this IBM, this is price chart of IBM. We can see here that it's currently trading at around $121. So every candlestick here is 1 day. So this is basically just about a year worth of information. It's trading at 121. So what we're gonna do to look at this example is we're going to be buying. First of all, we're going to be selecting which expiration we want to go with. And this is the information for the underlying, $121, bid and ask, etc. A lot of information that I'm not going to be looking at in a lot of details right now. But if we look at the expirations, that's where my main focus is going to be. We have all these different expirations, 7 days to go, 14, 21, 28, 35, etc., etc. We got all the way down to up to 651 days. So almost 2 years in the future. So the one that I'm going to select just to do the example is this May 2020, May 15th of 2020. So 35 days to go. And I select that expiration, and with the price at 121, I'm going to be buying the $125 call. So the strike price is going to be 125, and I'm going to be buying that call. Now, this is currently trading at 405 and 550. So you can sell it at 405, you can buy it at 550. So I'm going to be buying this contract. Now I'm just going to be, pushing some buttons here just to do it. Okay. I'm going to buy single, and let's take a look at the trading page here, or the order entry in this case for Thinkorswim. I'm buying, so a +1. The underlying is IBM. The 15th of May expiration. The strike price 125. I'm buying a call. Of course, I could buy a put as well, but I'm buying a call. Remember, the left portion of the trading page is usually calls. The price is 550. This is a limit order, good for the day, and exchange best. Okay, so I'm just gonna hit this button and just to take a look at some things. So as I was mentioning before, the $5.50 price is for one share, so one option. And remember, these contracts come in multiples of 100. So one contract covers 100 shares. So if we wanted to buy 100 shares of IBM, we would be putting down around $12,000. Okay, we're not going to be putting down $12,000. We're going to be putting down 550 times 100, so $550. We're going to buy it at 550. In reality, when you go into the market, you're probably not going to be selling at 550. You're probably going to be looking for a price closer to maybe $5 and not 550. But in this case, just to do the example, I'm going to buy it at 550. And I'm going to hit this button just to see some information. So I'm buying one contract of IBM covering 100 shares, the expiration 15th of May 2020, the strike price 125. It's a call at a price of 550 to open. So I'm buying to open. I don't need to find the seller. Remember when we were looking at our example, I needed to find for the call, it was a motorcycle dealer. I don't need to concern myself with that. I just buy it here. Where they get them from, I don't know. I don't care. My broker is going to be handling all that. I just go to the market and buy whatever it is I need. In this case, I'm buying an option, a call option, and I'm buying one contract covering 100 shares for 550. So the break even, it's already calculating it here for us. Remember, strike price 125 plus the price that we paid 550. So $130.50. The max profit, we were saying, it's unlimited, infinite. The max loss, remember, we analyzed it, 550. So 5.50 times 100. So you have to pay transaction fees, of course, something we haven't talked about. Any cash that you had in the account is going to be reduced by 550 because now you're going to have a call. And that's the information that we can get from here. Now, what I'm going to do is I'm going to simulate this and I'm going to analyze it. And thinkorswim has a tool called the Analyze tab. That's what I'm going to be doing here. I'm going to be analyzing this trade in the Analyze tab. So we're talking about a risk profile graph. This is exactly what I was talking about. You can see the blue line is the solid line, is the line at expiration. This is going to be expiring on the 16th of May, so one day after it expires on the third Friday of May in this case. So the blue line is at expiration. It's a solid line. It's a straight line and then an angle line, but it's still straight. It's not a curve. And the line representing P&L today would be the purple line. In this case, you can see that it's a curve and it's different than the blue line. So this tool, this Analyze tab, risk profile analyze tool, what it does is it allows you, it's a very powerful tool, and we're going to be using it a lot. It allows you to modify and do what if scenarios. In this case, for example, we start the position and we have the, we're going to focus on this portion. So the P&L open, which is the profit. So what will happen if on this day, right now we have today. So the underlying is trading at 121. What will happen if today, not at expiration, but today, the price went up to 139.55? So let's say 140, just for the sake of the example. What will happen if it goes to 140? Well, you put down 550 because that's what you paid for it. The P&L would be $1,054. So you would be having pretty much a 200% return on your investment. Of course, this was a pretty substantial move. So if we look at the chart, what we are at 121, and we are simulating the price going to 140. So if it goes up to here, you would be making, with $550, you would be making $1,050. Okay. What will happen if price stays the same? Well, if price stays the same, then you're not going to have a profit or a loss. This is probably just a rounding error. You pretty much don't have a profit or a loss. Now, if it goes to, what would happen if the price goes to 110? Well, if it goes to 110, we'd be losing $457. So we're going to be losing pretty much our whole investment, or a lot of it. But there's still 39 days to go, so a lot of things can happen. So you don't need to close it at this point because there's many more days to go. So this is how options work. They have a certain lifespan, and you can wait for them to you can wait for them to try to recover some of the losses in underlying price move. Now, as I was telling you, this purple line represents the today's P&L line, and we can simulate time passing by, and this is what I was telling you. Then as time passes by, the line starts approaching the actual solid line until at expiration is going to go there and merge with the expiration line. Okay, so you can see now you can run all kinds of simulations. What will happen if price goes to 130? You can see here more or less. If you look at the on the right hand side, you can see that it's making around $400. What will happen if price goes to 130 in 10 days? So we go 10 days further, and now if it goes to 130, it's going to be making $313. Why? Because the value of the option is less now because there's more time has gone by. Now, let's get something else here. I'm gonna set this day to today, and I'm going to do something here. I'm gonna get the break-even price. So this is the break-even price. We're talking about that. We paid $550, so the break-even is gonna be just around. This is considering some interest rate, so it's gonna be 125 plus 450 plus 550, so it's gonna be $130.50. So this is the break-even, and we can show it on the price chart so that we get an idea of what it's going to look like in the price. So this is where the price is right now. This is our break-even. So now visually we have a good idea where we need our price to go in the next 39 days. Remember, as long as you go over 125, your option is going to have some value, and then you need to figure out how much of that value you need to offset what you paid for it. So you need to go to around $130.55. So this line represents more or less where you want your price to go. So this is the risk profile graph. Now this tool also has, this trading platform also has a way to get theoretical prices for what your stock or what your options would be worth at different days, like on different days and at different prices. So for example, in this case, let's say you want to buy the 135 is trading for 133. So $133 for 100 shares. So for one contract covering 100 shares. And what will happen if in 10 days, so on the 20th, today is April 10th, the stock goes up by $30. What will happen if that happens? Okay. So what will happen on that day? Well, this price, this option, the 135 call is going to be trading, instead of for 133, it's going to be trading for 16.98. So you're going to be making something that costs you $133 is going to be worth $1,698. So this is just a different way to look at this information on Thinkorswim, which is the same thing that you can see here. You can analyze that trade as well. So if we analyze this trade, we can analyze multiple trades here. Okay, so if it goes, I'm going to do the same thing. 10 days go by. So now is the 20th of April. And I go to $21 more, so 140 or so. So here, we're talking about the 135, and the price, we simulated that it was going by $30. So it was going to 150. So with price, actually, we can simulate it here. Price at 150, we're going to have a profit of 1,400, which is the same thing that we saw here, because this went to 1,700 and we paid around $133. So just about 1,400 or so, which is the same thing that we're seeing here. A profit of $1,421. Right here, we can take a look at the price on the day and then at expiration. So now you are able to take a risk profile and to get the information from it that you need. You can figure out where the break-evens are, what the profit area is, where you make money, where you lose money, how much you make, how much you lose. For example, here you can see graphically that if price goes as low as 90, 80, 50, 10, doesn't matter, you're only gonna lose what you paid for the option. So this is how call options work. Buying a call, this is how this is affected, what your max loss would be. Max profit could be if IBM goes to $500, then you profit all the way. You're making here $36,000. Of course, this is unrealistic, but you can see how different buying a stock is from buying a call option. When you buy a call option, yes, you have time working against you, as you can see, because as time passes, the value of the call starts going down. You can see it graphically here, because if I start moving time, so now I'm on the 1st of May, 2nd of May, 3rd, 4th, etc. This curve starting to sag and go all the way down until it meets and merges with the solid line, in this case with the expiration line. So yes, you have some time going against you, but if there's a big move to the upside, you're gonna profit a great deal of it. So I hope that this was useful, and I hope that some questions about calls start being answered. And of course, there's going to be more lessons coming up. I'm going to do one for puts, which is something similar, yet the other way around. Now you're going to be profiting from the downside. But this is, now you can see what our risk profile is, and also how to use it, how to get information from it, and how it's translated into real life with real prices on real stocks. And in this case with stocks, it could be any underlying. Later on, we're going to see that there's many underlines that we can use. Thank you for your attention, and I hope to see you next time. Goodbye.